Well, the markets have no shortage of catalysts today, and we are going to get another big one in the next 24 hours. I'm going to try to figure out what it all means and where things go from here. I'm Ilya Spivak, head of global macro here at tastylive. This is Macro Money, and we are going to start here with a look at the way that the markets performed today, because, of course, that should tell us just how we are responding to those catalysts on the board. Not surprisingly, a complicated mix here, looking at, first and foremost, the influence of what appears like worries about geopolitical escalation in the Middle East. Of course, the situation began last week with Israel launching a strike directly against Iran's nuclear program, related personnel and assets. That still continues, but today, comments from U.S. President Trump that, quote, we control the skies over Tehran, even suggesting that we, again, in quotes, would at this point leave the Ayatollah be, but that the supreme leader's location is known and he is not an impossible target. Of course, the way to categorize this in saying we implies that the U.S. is directly involved. And some U.S. military assets have indeed been moving into the region. Now, maybe this is related to a missile from Iran aimed at Israel that appeared to graze the U.S. embassy in Tel Aviv, although no damage or fatalities were reported, no damage of substance, that is. Nevertheless, this is a U.S. asset being hit by an adversary, and so maybe this is saber rattling and a warning not to escalate against U.S. assets further. But then, of course, the president's comment calling for unconditional surrender, that seems to suggest something else. So lots of mixed cues here, but if in fact the U.S. is becoming involved directly, or at least the markets perceive that risk, it becomes understandable how you have equities down, yields down as bonds catch a safe haven bid, crude oil again spiking higher. Gold has interestingly stayed, which perhaps reflects the combination of catalysts here, but the dollar is up on the risk aversion as well, down significantly against both the euro and the yen. It does seem to suggest that there's some intermingling of catalysts here to see that the dollar is up and gold is being kept lower, which, if you had a haven kind of a dynamic, you might suspect that gold would be up in this environment, even alongside the dollar, because this would be a conversation about geopolitical risk and not about relative yield. But of course, things are complicated by there being a Fed monetary policy announcement, and indeed one of the big quarterly ones with a forecast update in the next 24 hours. But gold aside, the story here seems to be clearly of geopolitically driven risk aversion, where markets are getting defensive in the sort of usual way. Stocks down, yields down, so bonds up, dollar up, crude oil up. So that seems to be the majority of the message we walk away with today. And indeed, the bulk of these moves happen after the president makes his comments via Truth Social. So the prospect of U.S. becoming directly involved seems to be what's animating markets. On the data front here, retail sales came in worse than expected, down 0.9%. That's against expectations of a decline of 0.7%. So not terribly worse than anticipated, but fractionally so. Looking at the components, there does seem to be a little bit of a give and take here. Of course, in March, we saw this dramatic front running of auto tariffs give us a very big jump in motor vehicle sales, and that's, of course, significant because motor vehicle sales account for about 20% of the whole pie here. So this is a huge category. There was a huge spike in it. And in this latest data for May, you're down almost 3.5% in that huge category. So perhaps what we're seeing is normalization, just somewhat to a greater extent than anticipated. But nevertheless, if we look at the overall retail sales number, there was an uplift of 1.5% in March, standstill in April, now a more significant 0.9% decline in May. So the direction here not encouraging, although there is some fuzz in the data. And indeed, the consumer confidence numbers that we just saw from the University of Michigan last week, they point to a much more encouraging picture, a very spirited rise in consumer confidence as one-year inflation expectations fall back toward 5%. That's, of course, not anything to be terribly encouraged by relative to the sub 2 or the sub 3% expectation going into the beginning of this year. But nevertheless, it is a vast improvement over the spike to 6.6. So perhaps the damage done to consumers isn't all that great yet. Or at least there's some recovery, and the data in the retail sales numbers is backward looking. We'll have to wait and see. Of course, the reason this is so important is because frictions around tariffs going on and off, and that being reflected in downbeat sentiment, all of that aside, the real question is how much consumption do you get as a contribution to economic growth? And what we saw, of course, is that in the first quarter, it was the weakest in almost 2 years, going back to the second quarter of 2023. So if you were going to get concerned about recession, what you would get concerned about is consumption falling off. Because as we've talked about before, consumption is 68.5% or so of the overall GDP pie. Everything else is an afterthought for the most part. In fact, before we start getting worried about imports and exports, let's remember that they account for less than 5% of the entire GDP pie, whereas domestic household consumption overwhelmingly eats up the majority. So this we would to have concern, and at this point, at least, it looks like that picture is somewhat mixed. Which, of course, sets us up directly for a conversation about the Fed, where we are expecting to see that we remain on hold. We can see here for June, the median rate here expected to be unchanged at about 4.4%. We see that continuing into July. So standstill here for this meeting and for the next one. We start to see the inklings of a rate cut begin to appear in September, October, and ostensibly you have the first one of the batch here. And then there's the probability, narrowly, about a 56% probability implied here, that you get another one before year end. In fact, if we look at the cumulative tallies here, we've got 41 basis points that are priced in for this year. So in simple terms, that amounts to 25 basis points out of 50 already in the market. So that's one cut. That leaves 16 basis points of the next 25 on the board, and amounts to about a 50-60% chance that you get that second cut. So that's what you're looking at here. For next year, we have 59 basis points on the board. So basically 2 cuts with a slight 9 basis point nod in the direction of a third, but the likelihood there is so small that it's way, way too early to talk about a third cut. At this point, we're very close to the Fed's calculus. They've argued for 100 basis points. This is 99, and there's a slight skew toward the Fed starting late this year and spilling over into next year with a little bit more easing. But the overall structure here for at least one cut, probably two this year, and two cuts next. Now, from the Fed's perspective, they've argued that while they want to be cutting rates, the recent episode with the rushed rollout of tariffs and all of what that's done has complicated their calculus. And indeed, this has been their calculus right here. This is the latest update of the summary of economic projections. We can see here it has not changed in its forecasting of where rates are going since December. So if current rates, as we've just said, are 4.4 on average, down to 3.9 is 50 basis points this year, down to 3.4 is another 50 basis points. So from 4.4 to 3.4, that's one whole percentage point or 100 basis points between now and the end of next year. That has not changed here from December into March. And what the Fed said is the reason they're not changing it, even as they adjust growth and inflation expectations, is because they simply don't know which side of their mandate to prioritize. In fact, we saw that in spades in their statement, as well as the minutes from May's meeting. So here's the statement. We can see here, of course, a reference to that murky GDP data, but ultimately, uncertainty about the economic outlook has increased. The risks to both sides of the dual mandate here look like they're moving in the wrong direction. So the committee has judged that risks of higher unemployment and higher inflation have risen. That, of course, speaks to what the Fed has argued is the problem with tariffs is historically they have been something that drove inflation but hurt growth, and that puts the Fed's objectives in conflict. If they need to address the hurting of growth, they need to cut. If they need to address the boosting of inflation, they need to, at best, hold still or maybe even hike. And through that, there's a difficult way to figure out which way you're supposed to jump. Minutes from that same meeting show that there is a risk of higher inflation and higher unemployment, but also that the Fed is well positioned to wait for clarity, even as projections for GDP in 2025 and 2026 have been marked weaker since those March projections that we just saw right here. What does it mean to be well positioned to wait for more clarity? Well, the latest inflation data were relatively benign, 2.8% on core CPI versus 2.9 expected, and well within the recent range of outcomes. In fact, the makeup of the data was refreshingly normal, quote unquote. Not a really big swing in the contributions from food or energy. Goods inflation still very, very modest in its contribution, despite worries that the tariffs might create a big boost there. All of the inflation, for the most part, still baked into services out of a 2.4% headline inflation rate, 2.21 percentage points is core services. And then, of course, we got PPI data that gave us the lowest core wholesale inflation since August of last year. So, on the whole, the inflation story is not quite at the Fed target, but almost there and generally appears to be benign. And then on the labor side of things, here's the latest set of those numbers. The unemployment rate is, of course, a bit higher than these lows around 3.4, 3.5%. that were there 2 years ago, but we've basically anchored around 4.2%, and historically that is very, very low, and has been much, much higher. So this is not by any stretch a high unemployment rate as far as the Fed might be concerned. And although job creation has slowed, it hasn't done so catastrophically. If nothing else, in the recent range of outcomes over the recent years, these kind of ranges between the upper 300,000 and somewhere around 100,000 jobs created, that they have mostly held. And so you have this situation here that ostensibly from the Fed's perspective gives them time to think, because neither side of the mandate is flashing a bright red warning sign screaming, you must worry about this, you must worry about that. So when you consider what this means, if there's no actual policy change, we can clearly see on the menu here, if the vector for this to be market moving is really what Powell says in the press conference and the updating of these numbers, it seems like the Fed is positioned to do exactly what it did in March, which is nothing. However, you might get a downgrade further of these growth expectations. That's what we heard in May, that growth expectations at the Fed have come down, that risks are of higher unemployment and lower growth, and of higher inflation at the same time. So this adjustment here might have to move. You might see these inflation numbers tick higher. You might see this unemployment rate story tick higher. You might see this growth story tick lower. And because the uncertainty seems to be more elevated than it was in March, the ranges that the Fed sees for these outcomes might widen out to show that there's a greater disparity in possible outcomes. They're less sure and more could happen. All of which Jay Powell might then put a bow around in the press conference by saying, well, look, nothing has materially changed except for we are less sure of how this is going to play out. All of the same risks remain. The economy is not materially different in the meantime, so no reason for us to do anything other than what we've been doing, which is let the economy tell us which way to jump, and in the meantime, sit and wait. That's, of course, even more so amplified by there being cliffhangers on this U.S. tariff story that has so confounded the Fed. Reciprocal tariffs for countries excluding China see a 90-day pause expiring in early July, and then for China, it expires mid-August. So, not surprising, really, that the first Fed rate moves are after those things expire. There's no meeting in August, but the easing right now is set for after whatever happens with these tariffs is going to occur. The thing, though, here, despite the fact that the Fed is positioned for continued dithering and ambiguity, is that the market is not ambiguous. The market seems to be making up its mind. Since the beginning of the year, break-even inflation rates implied in the bond market have been falling. And while the stock market, this is the S&P 500 here, while it was responsive to the growth concerns that this thing implied, and so these things moved in tandem until early April, when you had first Liberation Day and then its temporary take-back, stocks have since rallied, but these break-even rates have not. And in fact, for about a month now, since the latter half of May, they have been falling. And what that tells the Fed is that inflation is not the concern. The economic weakness is. Whatever headwind is coming to growth to bring inflation down, that's the issue. And so the Fed really should be cutting. And so if the Fed then continues to dither, as it seems like they are, the upshot might be that markets need to start to price in more easing downwind. So this idea that you get delay up front, but even more easing later, that might need to start to expand out. And if that happens, then you probably see a little bit more life come into gold, see a little bit more life continue to build into long end bonds, and this rebound in the dollar might get stopped in its tracks as those rate cut expectations start to fan out. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise in just 30 minutes time, as I am every Tuesday, with Victor Jones for The Price of Truth. Stay around for that, certainly. It should be a spirited conversation. I will be, as ever, on with Chris for Futures Power Hour Mondays and Fridays, writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Good luck trading.